Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Tuesday, April 28th, 2026. Let's talk the markets, stocks, investing, the economy, insurance, whatever we can get to. Markets are giving back modestly from all-time highs. You'd probably say that the Nasdaq's not as modest, down 1.4%, but it closed at all-time highs yesterday. Russell 2000's down 1.1%. It's in at 2756. I think the Russell has a big question. It's up double digits for the year. I would think that Wall Street is assuming not record earnings, but more so lower interest rates as the reason it's up double digits. And with oil above $100 again, and chatter seems to be saying oil isn't going to drop and gasoline isn't going to drop for 3 to 6 months to get back to normal levels of pumping and delivery after the war ends, it seems like we're going to have inflation through the year. So that makes it tough for the Federal Reserve to cut interest rates. The S&P 500 is down 0.75%, sitting at 7118. The Dow Jones Industrial Average is up 58 points, sitting at 49,226. No need to talk about the VIX today. Not a lot of volatility there. Gold down 2.3%, sitting at 45.82. Crude oil at $100. Oh, and Bitcoin down 1.1%, sitting at $75,929. There's some concerns about OpenAI undercutting AI plays today. Keep in mind, we get big earnings this week, tomorrow after the market closes, and Thursday from 5 of the Magnificent 7 stocks. All of them except for Tesla and NVIDIA. That will be the ultimate versus a Wall Street Journal report out today raising concerns about just how much business OpenAI is doing these days. According to, quote, people familiar with the matter, the company's CFO is concerned that OpenAI won't be able to pay for the future computing needs if revenue doesn't grow fast enough. That has people who sell to OpenAI, such as Oracle, NVIDIA, and Corning, all pulling off and moving lower today. The report is the basis for the underperformance of the S&P 500 and the Nasdaq. If the Wall Street Journal report is a fallacious report, you would think that OpenAI, who's looking to IPO later this year, would come out and debunk it, and they have. Now, I guess you would say the damage has been done. Some of the goals missed reportedly include a target to hit 1 billion weekly active users by the end of 2025. It looks like it's missing its annual revenue target for ChatGPT last year. There's been multiple monthly revenue targets this year as Anthropic has surged ahead of the enterprise markets. Some investors might be spooked by this. Now, that hasn't exactly dampened an enthusiasm. The company recently just announced that it raised $122 billion, valuing the company at $852 billion. The company announced a revised agreement with Microsoft yesterday. You got that weird memo, and by weird memo, Sam Altman saying a lot of things that we do look weird, buying huge amounts of compute while our revenue is relatively small. So is OpenAI limping into the back half of the year? Google seems to be knocking it out of the park, as is Anthropic. Last year, late, Sam Altman reportedly called for a code red to improve ChatGPT. OpenAI spent 2026 championing its Codex tool and its higher availability of compute, two things the company hopes will drive revenues going forward. Now, an OpenAI spokesperson told Bloomberg that the company is firing on all cylinders, responding to that Wall Street Journal report. They have refuted it. But names like Microsoft, CoreWeave, NVIDIA, Oracle, AMD, Intel, ARM Holdings, Taiwan Semiconductor Manufacturing, Microsoft, Google, all have skin in the game. Oil prices are the other thing weighing on the markets this morning. Standoff between U.S. and Iran over the Strait of Hormuz persists. UAE is going to be leaving OPEC, bringing up a lot of questions. the third largest supplier behind Iraq and Saudi Arabia. But President Trump says Iran has just informed us that they're in a state of collapse. They want us to open the Hormuz Strait as soon as possible as they try to figure out their leadership situation. He finishes by saying, which I believe they will be able to do. According to CNN, Iran is expected to present a revised peace plan to the U.S. soon. It's earnings season, so we get reports from Coca-Cola and General Motors to talk about. General Motors upped its 2026 earnings guidance this morning after a big first quarter profit beat. Tariff relief following the Supreme Court decision is helping. They had an impressive earnings before interest and tax growth and a solid execution across its core businesses. The market's muted reaction reflects skepticism around the quality of the raised guidance, which was driven largely by a one-time favorable tariff adjustment rather than the underlying business's acceleration. There's cost pressures tied to the Iran conflict, introducing incremental uncertainty, particularly for international operations outside of China. GM's leadership in trucks, their growing electric vehicle share, and profitable crossover mix are clear positives. Investors may prefer to see more durable organic growth. It's not my kind of play, but I do report on it. It's a big part of our U.S. economy. Coca-Cola, have a Coke and a smile. $12.5 billion in revenue. They had a few extra days in the quarter. 10% organic growth is impressive. Coke continues to defy the mostly sluggish consumer packaged goods industry. Coke recently appointed CEO Henri Braun, continuing to put the consumer at the center of its strategy, which appears to be supporting the improvement in volumes, while North America and Asia Pacific stood out with sharp acceleration. The strength was not isolated, with growth across all and extending share gain to 20 consecutive quarters. Comparable operating margins also expanded despite higher input costs and increased marketing investment. The quarter was an encouraging read on the underlying demand, with improving volume trends and continued share gains supporting the view that Coke's consumer-led strategy is gaining traction. What are you, Coca-Cola or a Pepsi fan? It's a good question. Maybe, I don't know. Stock's up 6% today. Not too shabby. I know a lot of you old folks out there own this one in your dividend portfolio. If it's good enough for Warren Buffett, it's probably good enough for you, is the idea. I want to take note and tell you that if you had bought this in 2000, which is not unreasonable, it was a $42 stock. Now it's a $79 stock. Not really a good reason to own the stock, huh? But the dividend yield and knowing that they're not going to go out of business probably kept you in it. 2% dividend yield. 2.7% dividend yield. Not bad. Corning is sliding today after a mixed quarter. They reported results before the bell that beat expectations. The outlook for the second quarter of 2026 is the problem. The maker of fiber optic networking equipment now expects core sales to grow by approximately $4.6 billion instead of the $4.65 billion forecast by analysts. Management highlighted the company's powerful momentum across market access platforms, or 5 fast-growing industries ranging from optics to mobile consumers. But they also said we're going to have to spend $30 million on expenses this quarter as it upgrades and repairs a solar wafer facility to a permanent power system. Stock's up 85% this year, so not a surprise that it's down 8%. Lumentum is down 6%. Coherent down 6%. Ciena down 7%. All the stocks in optics have soared. A little profit taking makes sense, especially if you don't smash the ball out of the home run, out of the park, which would be a home run. Let's talk a little bit about the UAE quitting OPEC, citing desire to be meeting urgent needs of the market. The Middle East country will soon chart its own course on how much oil to supply the global markets, which have endured significant disruptions in light of the Iran war. The decision is taken at the right time in their view, because it's not going to hugely impact the markets. The market is undersupplied. I don't think the UAE appreciated Iran hitting some of their oil fields and infrastructure. The timing of the move comes as a surprise for some. Fractures between the UAE and some of its largest producers in OPEC have arguably been long in the making. The UAE was the strongest advocate for more aggressive boost to output during OPEC's post-pandemic slow return of supply, arguing that its productive capacity was too low. The Strait of Hormuz closure is likely to have lasting consequences for regional players and markets. And the UAE's exit from OPEC is one example. UPS had a good quarter. Nice revenues, nice earnings. UPS and FedEx are stocks that used to interest me, and now they really don't. UPS is a big dividend yield of 6% right now. But when you take a look at the last 5 years, UPS has gone from $228 down to $103. I can't have that kind of underperformance. Now, if you go back to 2002, it's as far back as I have it. It's gone from $55 to $103. Again, that's not kind of performance I can have. I'd be fired. I'd be canceled. One of the things I don't like about UPS, and don't get mad at me when I say this, is they're a big-time union. And being a big-time union is a problem because unions want more money and more amenities for their employees, which the biggest cost of doing business is employees. You know, I should go back and talk a little bit about the markets today. It'll be interesting to see if AI can recapture its momentum that it picked up in the last 3 weeks after basically being settled since October of 2025. There were some pockets like optics that did really well. It'll be interesting to see if by the end of this week, if the AI trade is back on. Domino's Pizza is having a good day, up 2.5%. A lot of post-earnings price target cuts. RBC cut the company from $400 to $355. It's currently $343. Goldman Sachs lowered it from $480 price target down to $430. Baird went from $495 down to $400. Restaurant stocks are bifurcated at this point in time, which is problematic. I saw that for the first time ever, Subway's going to have a value meal. Value meals are crushing companies at this point in time, crushing their margins. The Generation Z and millennials, who tend to be more of the pizza eaters, definitely in my family. My kids can pound a whole pizza now. I remember when I could do that. And now for me, it's just like, I'll just have one slice. I can't eat more than one slice. I don't know if it's too rich. I don't know what the word is, but it's not good for me. Let's talk about Generation Z and millennials right now. So not only are they cutting back on food, eating out, but they're cutting due to the high price of gas, due to the high price of groceries, housing, health insurance. Half of single Americans are now going on fewer dates or choosing less expensive activities because of rising costs. 48% of Generation Z and 40% of millennials said the high price of dating gets in the way of reaching their financial goals. A single date costs Generation Z adults $205 on average, and millennials $252 on average. That's crazy. Whatever happened to Netflix and chill? But even Netflix is $20 a month now. The typical Generation Z American went on about 9 dates in the prior year. 9 dates? That puts their annual outlay at roughly $1,845. 35% of dating apps have paid for one of the platforms. 35% of dating app users. The average paying dating app user spent around $19 a month. I have 2 events coming up, a Pints and Portfolio in May in San Mateo, and a wealth preservation and retirement planning event in June. You can sign up for both events. The June event is going to be in Foster City. The May event is going to be in San Mateo. The May event's on a Saturday from 11 to 1. It's I buy the beer. We talk financial planning. The wealth preservation retirement event is going to be 6:30 to 8:30 June 11th. That's a good event. You can sign up for either or event at robblackshow.com. That's robblackshow.com. Got a good show coming up. More tech talk. Some important tech talk, too. And then I have a strategy segment in the third. We'll take a break here. I'll be right back.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Taking a look at the markets as the morning moves on. It's more of the same. Maybe the Dow's improving, but the Nasdaq's down 1.2%, which is roughly where it was at. The S&P 500's down 63 basis points. Off all-time highs, but when you're down less than 1% from your all-time high, that ain't so bad. Russell 2000's down 1.2%. Some of the headlines out there. OpenAI linked stocks slump on report of missed targets. They've refuted that. Oil prices have erased the ceasefire losses as Iran offers a peace plan. We'll see how this plays out in the next couple of days. Oil prices jumped on Tuesday, erasing all the ceasefire losses on reports President Trump will publicly reject a peace plan offered by Iran, while the United Arab Emirates said it will leave the OPEC cartel in May, dealing a major blow to the oil bloc. Meta's earnings are expected to shine a spotlight on spending, with CapEx nearly doubling from last year. They report tomorrow after the market closes, as does Google, as does Amazon, as does Microsoft. On Thursday, we get Apple. Travelers are starting to balk at sky-high airline ticket prices, Bank of America data shows. Air travel traffic has slowed substantially as consumers face the higher ticket prices and baggage fees since the Operation Epic Fury. Traffic's fallen below its 2024 and 2025 levels, since air tickets tend to be purchased on average 6 weeks before travel. The slowdown is likely due to the impact of the Iran war on not only airlines, but also on confidence. News reports of long security lines and flight delays due to TSA disruptions might also be weighing on consumers' willingness to fly. I'd agree with all that. I'm not all excited to travel right now, but I do need to. You only live once, and I have the money. So, what do you like to spend money on? I like restaurants, good quality food, whether it's at home or restaurants. Travel and leisure for sure. I stained my deck this weekend, and I like preventative maintenance. You know, it's a wood deck, so rain in the Bay Area tends to sit on it. During the winter months, it tends to rain a lot, so it just sits on it a lot and rots the wood. So I stained it every 3 to 5 years. Where am I going at with this story? Oh, I celebrated over the weekend. When I was done staining, me and my son grilled some nice ribeyes. So I don't know if you've ever had a Hawaiian ribeye. It's probably one of my favorites. That pineapple just makes the meat so sweet. But that was teaching my kid how to barbecue. It's one of the things that I really loved when I turned 21, 22, and I moved out and moved on from college. When I started adulting. And I want my son to have that joy. Sitting in the backyard, having a beer with a friend, and cooking up some steaks. It's something I definitely want to pass on to my kids of what made me happy. Because then I started working, and let's just say I'm 23% less happy. Let's hit some other stories out there. Spotify posted solid first quarter growth that beat on top and bottom line. Earnings were $4.04 compared to expectations $3.73. The print reinforces that the core business is fundamentally strong. The stock's down double digits today, I think 12%, improving engagement, real pricing power, credible margin expansion at the gross level. Market reaction reflects a growing focus on the quality of earnings and the sustainability of operating leverage as increased investment in AI into infrastructure and marketing begins to weigh on near-term profitability. The second quarter guide, while not weak in absolute terms, signals that the elevated costs will persist through at least the first half of the year. challenging the near-term margin trajectory. The ad business transition and continued deferral of its recovery to the second half remains a key overhang. Ultimately, investors are being asked to underwrite a heavier investment phase in exchange for longer-term monetization upside, a trade-off that will likely require clearer proof points, potentially at the upcoming Investor Day, before sentiment improves. Here we go again. The FCC is going to review Disney's broadcast licenses as the Trump administration puts pressure on ABC over Jimmy Kimmel. I believe late-night comedians should have the right to free speech, as long as they're not screaming fire in the case of using a gun at someone or in a movie theater. What else do we have to hit? Cadence Design Systems reported a strong quarter with guidance for the current quarter ahead of expectations. Software provider to chip makers is integral to NVIDIA and the whole ecosystem. If you and I wanted to come up with a product that, let's say it's like a Star Trek badge that you wear on your shirt and you tap it and you say, take a memo. I need to be reminded to mow the yard. And then it sends it to my email or it puts it in my to-do list. If we were to design a semiconductor, we don't need a GPU. We don't need super high end, so we'd probably use an application-specific integrated circuit. And Cadence makes the software that allows you and I to build this business to get the semiconductor, right without actually having to buy a silicon. Big difference between silicon and silicone. So the Bay Area is the Silicon Valley. LA is the Silicon Valley. Work with me on that. That's funny. Let's talk about Apple. Price target raised to $287 at UBS from $280. Supply chain checks analysis of sell-through data suggests modest upside of iPhone estimates, with demand for the Neo and Mac Mini suggesting demand at least in line with Mac revenue forecasts. For services, we don't expect upside to our 14% revenue growth, they said. Therefore, the March quarter, we expect slight upside to our $109 billion estimate. Wow. Consensus is about $109.3 billion. Expected services gross margins of 76.5%. They expect consolidated gross margins of 48.5%. At this point in time, when you sell so many damn phones, it's all about the margins. Yesterday, I talked about OpenAI is working with MediaTek and Qualcomm to develop a smartphone chip with Luxshare handling the system co-design. Mass production is expected in 2028. This is going to be a thing. AI phones. So can someone break in and get 1 billion plus users like Apple has? Or will it meet resistance of the masses, of the groupthink? Some of the talking heads spoke about this. One of them, Chamath, said the past 50 years of computing was about investing in form factors to interact with information, retrieve information, search for information, edit information, save information. AI is all about interacting with knowledge. It's completely different. Agents and models. And then another tech analyst said smartphones are peak device. That got me thinking, that's a cool statement. Any AI device will be an accessory of the smartphone. Basically, nothing will replace the place of the smartphone. It's essentially perfect. Thin, light glass slab with all-day battery, cameras, and connectivity. I agree with that. Microsoft price target was lowered to $505 at BMO. They lowered their target to $505 from $575. Analyst Keith Bachman said, with ongoing investor concern for software and the results that will likely have modest upside, we do not think Microsoft's March quarter report will serve as a liberating event. We believe that 2027 consensus CapEx expectations are too low. With history as our guide, we believe that the management could make some directional comments on 2027 CapEx, which we would view as a potential clearing event. They maintained their outperform rating and lowered their price target from $575 to $505, given compression in software valuations. One of my favorites to read is BTIG's Jonathan Krinsky. Sometimes, he said last night, sometimes when a position or idea goes against you, it lowers your conviction. Other times, it actually emboldens it. For semiconductors and high momentum in general, we find ourselves in the latter camp. The move in the SOX is like a stretching rubber band, and the band stretches further. It just doesn't stop and sit there. It needs to have pressure continually applied to keep it stretched, and if you keep pulling it further, eventually it snaps. That makes me feel bad. Talking about fundamentals, they don't mean good things can't go down. In early 2025, Meta went up for 20 straight days. Fundamentals were great, but after the winning streak, the stock gave back 35% over the next 2 months. Talking about tops, they're not always obvious in real time. Using silver's parabolic peak as an example, on January 29th, silver initially fell 12% from its all-time highs, then recovered most of the decline by the close, leading many to think the worst was over. Yet the next day, the real decline began, with the XAG down 38% over the next 19 hours. Silver is far higher beta than semiconductors, so we're not expecting that magnitude of a 24-hour move, but the point stands. Tops aren't always obvious in real time. He talked about one for the history books. In the month ended today, the SOX, the semiconductor index, second best monthly gain on record, up 36%, trailing only February 2000. Over the past 20 years, the prior best monthly gain was up 18.5% in November of 2020. In other words, the current monthly gain is essentially 2 times the next largest month, post.com. He's throwing it at semiconductors today, huh? Looking beyond semis, he's taking a look at the Nasdaq Composite's 8th best month ever, up 14.7%, dating back to the 1970s. The 7 prior instances fall into 2 buckets. The first includes months preceded by bear markets. Those 5 months were preceded by an average decline of 52%. The second bucket, those were preceded by mild pullbacks. The current 14.75% monthly gain was preceded by a 14% pullback, making it the third smallest pre-rally pullback of the set. Make that what you will. Meta is getting ready to post its highest revenues growth since 2021. FactSet's calling for $55.6 billion in revenue. Meta guided itself for $53.5 to $56.5 billion, up from $42.3 billion a year ago. AI has helped extracting more value from social media giants' massive advertising business. Meta is expected to surpass even Google in net ad revenue this year. The company is also slated to post earnings per share of $6.67, up from $6.43 a year earlier. As CFO of Meta, Susan Lee, put it during the fourth quarter earnings call, we expect the set of investments we're making in 2026 will enable us to drive further gains as we continue to integrate AI across all layers of the marketing and customer engagement funnel. Let's end this segment with a great wall of profit. China's factories minted money last month, ending a 4-year slump and effectively shrugging off the global energy squeeze sparked by the Iran war. The world's second biggest economy saw its industrial profit rise 15.8% in March from the same time last year. Part of that was thanks to the government's decision to roll out fresh economy-supported measures like tax breaks, public works, and cheap loans. At the same time, global infrastructure spending has been booming, and a good chunk of it runs through Chinese factories. A big part of that's high-tech manufacturing. We're talking semiconductors, EV batteries, and industrial robots. China's kicking our industrial butts right now. So if Chinese factories are thriving, that's a positive sign for the world. China makes a lot of chips, but they're mostly the older kind. It imports the latest and greatest from Taiwan and South Korea to feed its tech sector. China is an extra floaty, if you will. The country's dominance in EVs, solar panels, and renewables means that every barrel of oil that doesn't have to buy, it makes it's that much more stable. So they've done a nice job, and they look prepared for the oil shock that the rest of the world wasn't. Let's take a break here, come back, talk a little strategy. Have an event coming up, Pints and Portfolio, Saturday, May 16th, 11 to 1, and then 1 month later, June 11th, I'm going to do a wealth preservation retirement planning event with CFP Chad Burton and CFP Ryan Ignacio. You can sign up for either event. That one's in Foster City at robblackshow.com.
Brought to you by EP Wealth. This is the Rob Black Show.
As always, thanks for listening to the show. I feel honored to be in your media world. Thank you so much. This is a segment where I like to talk a little strategy. And 30 years ago when I got into this industry, I was a voracious reader. I've always been a voracious reader. I grew up overseas and we didn't have television. I was an American living in Europe and it stank. I wanted to watch cartoons, but all I had was Tolkien and Lord of the Rings and The Hobbit. I was a voracious reader, and I think it paid me well, if that makes any sense. One of the books that I got into when I started in investment research was John Bogle's The Little Book of Common Sense Investing. It's pretty top notch. The book is the definitive guide to index fund investing and keeping your costs low to maximize returns. If you want to understand how millions of everyday investors quietly build wealth, it's without chasing trends or timing the markets or paying high fees. You end up at one place, the philosophy of John Bogle and his classic, The Little Book of Common Sense Investing. What makes the book endure is not that it's complex or tough to get through. It's not magic. It's the opposite. Bogle takes the industry built on noise and strips it down to a few truths that are almost uncomfortable in their simplicity. Bogle's core argument is straightforward. You don't need to beat the market. You need to be the market. You need to own the market. The means investing in index funds, low-cost funds that track broad markets like the S&P 500, rather than trying to pick winners of stocks. And when you account for taxes and fees, the professional doesn't typically beat the market. To the point that Warren Buffett once challenged a hedge fund manager. He goes, over 10 years, let's start with $1 million each and see who has more money after 10 years. I'm putting my money in the S&P 500. He beat, with that stupid, that simple, that clean bit of advice, he beat a hedge fund manager who's paid, handsomely to be the smartest one in the room. A portfolio earning 7% annually versus 6% after fees doesn't sound like much, but over 30 years, that difference can mean tens of hundreds of thousands of dollars. Bogle says you can't control the markets, but you can control cost. And he's absolutely right. I don't know if I'm going to do this completely or not, but part of my strategy on leaving my kids money is to get them out of stocks, unless it's dividend paying stocks. And then it'll be like Caterpillar. I'll say, never ever sell it. I don't want my kids doing what I do. It's too much damn work. It's in my head everywhere I go. The investing industry thrives on stock pickers like me. There's always a smarter manager. There's always a new edge. Today's top performing ETFs and funds rarely stay on top, though. Chasing performance usually leads to buying high and selling low. Complexity often masks underperformance. Own everything, reduce regret. If you've owned the S&P 500, the very few select winners have carried that index. Most of the stocks in the S&P 500 are down, but companies like NVIDIA and Microsoft and Meta and Amazon, they've done so well that they're carrying the markets. Instead of betting on one sector or one stock or one theme, go for hundreds of companies, and the winners in those industries will carry the rest of the index. There's a saying in our industry that time in the market beats time in the market. Markets are unpredictable in the short term. This goes against my whole damn radio show. And I'm telling you, it's one of the best books ever. Trying to time the market usually backfires. I've never seen anyone do it consistently well. So I want you to ignore the noise and I want you to live your life. I want my kids to ignore the noise and live their life. This weekend, I had to go through, wait, someone tried to kill the president again? What is his Department of Justice and FBI doing? Like, it shouldn't even be close.
What was that all about?
I don't want my kids in that world. I want my kids like loving their spouse, loving their dog. So the Little Book of Common Sense Investing isn't about getting rich quickly. It's about getting rich reliably. One of my favorite books was called A Little Book on the Human Shadow. I think it was by a guy named Bly. And it just basically talks about how you have your body, but your body has an image that's pretty close to it. For some reason, I like these little books. It has Robert Bly, A Little Book on the Human Shadow. Fantastic read. Everyone I've given it to, they hate it because it makes you think, and you get a headache by the end of it. So some other, ideas in the world of investing. Try to read as much as you can. There's a book called The Psychology of Money. There's a book called The Simple Path to Wealth. Notice that it says simple. Warren Buffett was a disciple of Graham. He said most investors should just buy index funds, very much in Bogle's camp. So accept the rules change in your life. Traditional advice is that we work for 40 years, we retire at 65, we live off a pension. That's gone. I like the index fund idea. I'm not against it, even though my show is staunchly against it. Invest early, keep investing. Use diversification as your foundation. I'm loving my small caps right now. They're rocking and rolling. I love the idea of keeping costs low. Don't try to time the market. I've never met a market timer worth $1 million who did it from like $10,000 to $1 million. I went from $10,000 to 8 figures investing in my lifetime. Now, again, I've put new money in, of course, but I started very, very small. Anyhow, tax advantage accounts like 401ks, 403bs, 457s are amazing, as are IRAs and HSAs. They're the essential wealth building tools. I look at investment returns after taxes. So if I tell you I've got an 8-figure account that's really only worth 7 figures after taxes, I really only have 7 figures. Do you see where I'm going at with this? Just try to be a little more honest with yourself. Simplicity beats complexity for the average person who doesn't do what I do and drive themselves crazy with research. You can always find me online at robblackshow.com. That's robblackshow.com. I do have a Pints and Portfolio coming up. It's limited to just 10 people. It's in San Mateo this time. It's in the middle of May on a Saturday. It's going to run from about 11 o'clock to 1 p.m. It's a good chance for you to get your financial planning questions answered. Saturday, May 16th. Sign up at robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.